This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial. And today I'm speaking with Caleb Doane, their vice president, about some very interesting things that's happening in the market right now. Hey there, Caleb.
Hey.
How are you?
I'm doing well. How are you doing?
Good. Okay, so you said it. You said it one of the last times you were on that, you think that there's going to be an interest rate cut happening soon.
Yeah.
Okay. And guess what, guys? It's happened. How did you know?
Yeah, exactly. Well, the market kind of has some predictions sort of built in, so you can tell with a certain level of certainty what you're expecting there. But I think a lot of people are wondering, hey, if I didn't do something before the rates were cut,
right,
and they were cut in September by 1/4 percentage point, the expectation is that there still will be at least another rate cut by the end of the year. That can always change, but people are wondering, hey, if I didn't do something ahead of time, is it too late to make a change? And it's definitely not. So, people still have the ability to make the necessary changes to kind of protect their portfolio or set themselves up for success, especially if they have a lot of money in cash, CDs, or high yield savings accounts. Those are kind of some of the accounts that we see that might need the most significant changes as rates get cut.
Okay, got it. And can you break down what exactly is an interest rate cut? Like, where does it come from, and what does it mean for us as individuals?
Yeah. So it comes from the Fed. So Jerome Powell is chairman of the Fed right now. So he lowered interest rates by 1/4 point, and that really trickles down through the rest of the economy. So that usually impacts the rates that you can get on CDs, your high yield savings account, your regular savings account at your bank, mortgage rates, car loans. It really impacts everything across the board. And if people are used to getting high rates on their CDs or their high yield savings accounts, those can start to get lowered. And so as that happens, we start to think, okay, is there either a way for us to lock in these nice interest rates, these high interest rates, for a longer period of time before they get cut again? Or do we start to look at maybe increasing the risk a little bit, maybe going into the stock market with some of the money? It's not as safe as what a CD is, but over time, depending on what somebody's time horizon is, they might be able to earn a little bit more than what they would in the CDs, especially as rates go down.
Okay, and so since this has happened a little bit later in 2025, what happens to the beginning of the year? Does it kind of activate the interest, or does it really start now?
Yeah, it starts right now, right when they lower it, which was mid-September is when they lowered the interest rates. It takes place right now. But people might not feel the impact until maybe a CD comes due. So maybe they bought a CD or got into a CD 6 months ago, and it was a 1-year CD. They got it for 4%. Maybe that CD isn't renewing for another 6 months. By the time that CD renews, the bank might say, hey, I know you got 4% before, we're only going to give you 3.5% now.
Okay.
And so people really might not feel it for a little while, and it's still a perfect time to start making some of those changes. So if you're somebody with a lot of money in cash, a high yield savings account, or CDs, now's the time to start talking to a financial advisor to see what could be done for your specific situation.
So with the rate cut going down, does that apply to the example that you gave where right now they could be sitting at 4%, but next time they renew it, it will be for lower?
Yeah, that's typically what we see.
So that means it's a negative. The rate cut is negative on the sense of you don't yield as much in your savings, but it's a positive when it comes to lending.
Right.
You'll get a better rate.
Yeah, that's typically the case. So like with mortgage rates, if we were to see rates continue to go down, we would expect to see mortgage rates follow that too. Now, it's not always perfect. It doesn't always immediately go down right away. Sometimes companies are expecting, rates to maybe stay the same or maybe even go up in the future. But typically, if the Fed lowers interest rates, then we see those mortgages follow that too.
And once it's lowered, about how long does it stay at this level before they reassess if they need to raise it or lower it again?
Yeah, they meet, every month or every couple months to talk about changing the interest rates. And really the Fed is trying to keep a few different things in tolerance. They want to keep inflation low and they want to keep Americans employed. So those are kind of the two things that they're balancing there. If they lower the interest rates, sometimes that can cause people to spend a little bit more money. They're taking on more debt because it's cheaper to do so. That can have an impact on inflation and make it go up. But then usually it helps the other side of the equation. So they're kind of balancing those two things to try to make sure everything looks good. And that's why it's a tough job at the Fed right now, because they want to make sure Americans stay employed. They want to keep unemployment low, and at the same time, they want to keep inflation low too.
Yeah, and it doesn't help the pressure that they are receiving from the White House. It doesn't make their job any easier. So if someone's just now learning about this rate cut, how can they still take advantage of it? Because you said it's not too late.
Right, yeah, it's not too late. I would say give us a call. There are plenty of options. One of the options that we look at is getting into what's called a MYGA, a multi-year guaranteed annuity, and that can lock in the interest rate for a longer period of time. A CD might only lock it in for a year. A MYGA could lock it in for longer, and you get that guaranteed interest. Once you get into it, the interest rate won't change. So even if the Fed lowers interest rates, doesn't matter because you've locked it in early. Another option could be starting to go into the stock market, possibly. That depends on what somebody's time horizon is. It depends on their risk tolerance. Obviously, a CD is much more conservative than the stock market, but moving money into the stock market can be good for some folks depending on their current situation. So there's a lot of options that we can use. Everyone's going to have an individual customized plan. So the first step is just reaching out, taking advantage of our complimentary consultation that we have with clients. So if you're somebody with a lot of money in cash, CDs, high yield savings accounts, give us a call and we can see.
All right, awesome. Thank you, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, there are so many options that Caleb just laid out. It only takes you making a phone call to chat about them. And we'll also have their website listed below, and I'll see you after the break. This segment sponsored by Foster Financial.